When it was 1 and 2%, it was fantastic.
So that's ideal for a first-time buyer.
And obviously that had the huge boom in terms of the market.
When you get property in your blood.
I don't know, it was a little bit difficult for us because we didn't really know what we wanted.
Ladies and gentlemen, welcome to episode 4 of the First Time Buyer Show, where I speak to professionals in the industry and we're going to assist you in buying your first home. Today, we've got Simon Garthwaite as our guest. Simon, how are you doing?
Thank you, fine Peter, nice to be here.
Very good to have you. So, before we start off, do you want to introduce yourself, what you do is work, let the viewers know?
Okay, Simon Garthwaite, mortgage advisor, started in 1989, could you believe?
Good few years, that, isn't it?
Yeah, long time, and lots changed in those years, a heck of a lot, but there you go. Fundamentally the job is the same. You're helping people get a mortgage, you're helping people buy a house. That's never going to change, and I basically love it.
Amazing. So 1989, I'm sure you've seen a lot of different trends in the property industry since then.
Yeah, so I suppose the biggest one was being at the cold face for the financial crisis in 2008.
What happened?
Well, basically the world ended overnight.
Yeah.
Literally, the world ended overnight, and it was just a disaster from start to finish. And it recovered, and we're now back to whatever normal times are. But it was very, very interesting.
Of course. And I mean, you know, talking about that 2008 crash.
Yeah.
What were the interest rates back then? What did they get up to? What were they? Because now, if you look at them, look at the interest rates now, people are complaining about them. They may be saying they're a bit too high, but back then, how was it?
No, that's a really interesting comment. So what people don't realise is that the interest rates now, which are considered high, are identical almost to what they were before the crash happened.
So around the 5s.
Yeah, but you see, what happened was the world ended overnight, and then over the next few months, the interest rate was slashed down to virtually zero. And this was supposed to be at the time a temporary measure, but the interest rate stayed close to zero for the thick end of 15 years. So you have a whole generation of mortgage borrowers and homeowners who've never known anything other than interest rates close to zero. It's now gone back to 4, 4.5, 5, whatever it's been in the last, and all those people feel understandably that the rates are through the roof. But what they don't realise, and there's no reason why they should, because they weren't even around before the crisis, is that everything's just gone back to normal now. They're not high at all.
That's what I see as well. I can see it does seem to be normal, because when I speak to people, they always say, you know, back in my day, the interest rates were even higher, even up to the 6s and 7s. So now for us, I think it's, you know, a benefit for the younger generation that they are at the 4s.
It is. I mean, these days of close to zero, they've gone for the while. Everybody's hoping they're going to come back, but it's more wishful thinking than...
Well, when you say they're hoping it's going to come back...
Well, everybody wants to pay less, because what's happened, of course, is that people were on these diddly squat rates,
and they got used
which
to
you
it.
can't get anymore.
No.
And they understandably considered that was at the time the norm.
Yeah.
And of course their rate has ended, and they've now gone what they feels like through the roof, and that's a shock to the system. So they want it back to where it was, but
It's not happening.
Say in the context of the last 30, 40 years, it's not really high now. It's just gone back to normal.
Yeah. And, you know, from a first-time buyer point of perspective, when you're looking at the previous interest rates, when they were near enough zero, you know, 2020, 2021, and they're potentially looking at buying a house now, but they can see that the interest rates are around the 4.5%, 5% mark, and they're potentially holding off. What would you say to them? Would you say just go for it, or would you say hold off a bit?
No, no. This is going to sound really cheesy. This,
yeah.
but I promise you, it's correct. Trying to wait for the right moment to buy a house is a bit like waiting for the right moment to have kids.
Yeah.
There isn't a right moment. Right? If as a couple or a guy or a girl or whoever's buying the house, if at that moment in their life it's the right time to buy a house, it's the right time to buy a house. Now say, I know that sounds cheesy, but that is it.
Just go for it.
If it's the right time, it's the right time. If it's not the right time, it's not the right time. But it's nothing to do with interest rates.
Yeah. And I mean, also touching on that as well, because at the minute in time, I'll speak about it, I'm going for a remortgage myself.
Right.
You know, I bought a property over 2 years ago.
Right.
And the property value has gone up, but the interest rate when I bought it was at a high.
Yeah.
But because the property value is going up and I'm getting a remortgage, I'm able to pull some money out. So is that something you could advise to first-time buyers? Just get on the ladder and in 2 years remortgage because the prices are always going up?
Well, they usually go up. Always is nothing's guaranteed, of course. But no, if it's the right time for a first-time buyer, it's the right time for them to buy.
Yeah.
Deposit they need, obviously. But yeah, if it's the right time, it's the right time.
Amazing. And when you say deposit there, a lot of first-time buyers sometimes get... There's a lot of confusion around them. I'm sure you've spoken to them, you know, do we need a 20%, 10%, 5%? What's your opinion?
The situation with deposit is always the same. The more, the better.
Yeah.
Just the more you can put down, the better. But 5% is your starting point.
Okay.
You can get away with 5%. Obviously, the more, the better. And each milestone of deposit is the next slice of 5%. So if you can reach 10%, better still. If you can reach 15%, better still. If you can reach 20, etc., etc. But you can start at 5. You can start at 5% of whatever the price of the house is.
So, for example, you know, you've got a first-time buyer, a couple who are saving a bit of money. They've not got much, they're scraping a bit together. Obviously, you know, they can go in at a 5% mortgage. There shouldn't be any issues with the lender at all, no?
No, not at all. With 95% mortgages, they are a bit stricter in terms of you do pay a slightly higher rate, not a lot higher, but you do pay a fractionally higher rate for being on the minimum deposit.
Yeah.
And
so the rate goes up slightly if you're on a small deposit?
Yes.
Ah, okay.
This is why I was saying before about the 5% slices. Yeah. The world gets prettier and prettier every time you reach the next slice of 5%.
Got you.
Now,
Got you.
the other thing about 5% deposit, 95% mortgages, the customer must be absolutely whiter than white in terms of credit history. There's no room. There's no room for any blips at 95%. There's probably not much room at 90% either, but there's even less room at 95%.
So your credit score's got to be bang on the money.
It does. It has to be
to get on that
better than bang on the money at 95%. There's very few. This is a thing which has changed a lot going back to that financial crisis. One of the things that after it all went wrong, and there was a tremendous amount of enquiries about, oh dear, what was the problem? And there was a number of huge problems identified after the event. One of them was that people were lent and borrowed too much money, and the other one was that people with bad credit were lent too much money. So they've tightened up tremendously on that. So there's no wriggle room on that, really.
So nowadays, as a first-time buyer, how squeaky clean does your credit score need to be? Because I know that's, you know, it's a lot of talk about it no matter what when you're a first-time buyer. How good does it have to look? At
95%, well, let's just try and clarify what good means.
Yeah.
So good doesn't mean you've got a load of credit. It means above all, there are no bad marks.
Okay.
That's even if you haven't got any credit or very little credit, that's okay. What matters most of all is that there's no bad missed payments on the credit file, because that just kicks it straight into touch if it's 95%.
Okay, and then,
So it's got to be squeaky clean.
right.
Yeah.
What would you advise to the younger generation who are looking to buy the first house, first time buyers? You know, even sometimes, you know, the average buy-in age nowadays is around 33, 35.
Yeah.
What would you advise to these people to build up the credit score? Would you tell them to take out credit cards and only use 30%? Because that's sometimes what I say to people. Is there anything else you'd kind of recommend for them to build up the credit report?
No, you're right. Get a credit card.
Yeah.
Use it regularly, but for goodness sake, pay it on time every single month. Because the worst thing you can do is take the credit card, use it, miss payments. You'd have been better off not getting it in the first place.
Yeah.
So, yeah, do that, but for goodness sake, make sure you don't miss any payments.
Yeah, yeah. So that's the issue as well with the younger people. Sometimes when you get a credit card, they can go pretty mad and they can spend it all at once.
Well, they can do, and it's you know, that would be not a good idea.
No, I even know some people, you know, who can max it out. They'll go on like the £2,000 allowance, max it out, and you know they'll still be paying it off a year later. That must surely do some damage to your credit report. It surely must do.
Well, when a mortgage company assesses somebody for a mortgage, they look at the whole thing, and if they see somebody that's continually at the limit on a credit card or credit cards or in the bank account, there's nothing wrong with using your overdraft. But if somebody's got £1,000 overdraft and they're continually £995 overdrawn, the lender ain't going to like it, because they're going to look at it and think, these guys are on the edge. It only needs to go a little bit the wrong way and suddenly they fell off the cliff.
Yeah, exactly. So
they don't like that.
So could you advise to someone listening now, because you know I can't give out any advice or anything, but I'd personally advise to someone to get a credit card and just pay for the fuel on it, pay it off monthly, just show that. That's what I've done.
I think that is a good strategy.
Yeah, just pay your fuel off, pay it back monthly.
Yeah,
It shows
make
good
sure you
credit
don't miss no blips.
Yeah.
Okay. Yeah.
What is one of the biggest challenges you've had dealing with first-time buyers? You know, what's a challenge that they can come across sometimes when applying for a mortgage? You know, is there anything that really sticks out to you?
In recent years, again, on the back of the financial crisis, keep going back to that.
Yeah.
I know it's 15, 16 years ago now.
It caused a big damage, didn't it?
But
Still paying for it now.
The world today still is shaped by what went on then.
Yeah, okay.
So there's a number, so to answer your question, one of the things that came off the back of that was it was decided, once all the inquiries had taken place and all the rest of it had gone on, that people were lent too much money.
Yeah.
So lenders now, their affordability calculators, which trump everything.
Yeah.
If a lender's affordability calculator says to a customer, you can borrow £151,000, don't even ask for £152,000, because whatever that calculator says is written in stone. Now, not all lenders are the same, but whatever it says is the figure. Now, going back to answer your question, one thing which people have suffered from since the crisis is they used to be able to borrow a lot more than they can now.
Yeah.
And you know, it depends where they're living, of course. I mean, Southport is not a cheap area.
No.
You know, so sometimes the salaries that people are on, they can't always reach the amount they need to get the house they want. So affordability it can be an issue.
And how do the banks go off affordability? You know, is it how much you earn per year and then you multiply it? Is it usually between 4.5, but I am seeing some lenders go up towards the 6 times the amount.
Right.
I'm seeing that.
Yeah, so these high multiples, which always make the headlines.
Yeah.
You've got to remember that they are for. You need a huge deposit.
Is that right? Okay.
Yeah.
Huge deposit.
Normally, for first-time buyers, you're not going to get that kind of multiple, because the deposit that you need to get that kind of multiple, most first-time buyers haven't got.
So what's usually 20% or? More.
To get the big multiples,
6
I would say 25%, even more.
Really?
But the when you see these headlines of 5.5, whatever it is, multiples, that's for huge deposit, probably earning a minimum salary of, 100 grand a year.
Yeah.
Very little outgoings. The perfect case, you'll get that sort of multiple. But for normal cases, you're looking more, between 4 and 4.5 times.
Yeah.
That's the norm. But these calculators now that they are quite sophisticated. There's all sorts of algorithms behind. You just literally put the numbers in. You put the salaries in. You put what commitments they've got, whether they've got any children, blah 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 blah, how much deposit they've got, and it literally spits out a number at the other end. Now, there's a lot of behind the scenes calculations gone on before it gives you that number at the end. But it is fundamentally based on how much you earn. Obviously, the more you earn, the more you can borrow. Mm-hmm. But it's not just as simple as that. There's other stuff going on as well. But 4 to 4.5 times is about right for most first-time buyers.
Right. And obviously, we're talking about the bright headlines, the 6x multiplier, and I think another headline that's coming into place: 100% loan to value, so 100% mortgage, no deposit whatsoever. What's going on?
There's a couple of schemes where they tend to be specifically for somebody who's been renting and wants to buy the property that they're renting. Then I think Skipton do a 100% scheme for that scenario, but it's very, very narrow. And I mean, again, going back to the days before that was another thing before the financial crisis. 100% was sort of quite common. But
what were the multipliers back in 2008 days?
Well, it was, the multipliers were more generous, but it wasn't just the multipliers. It was the fact that you didn't need a deposit. If you had even with a 95% mortgage before, you could have bad credit and still get it. Well, them days are gone.
Yeah.
So it wasn't just the multipliers. It was just everything was so relaxed.
Yeah.
And hence the problems. It was always going to go wrong at some point.
100%.
But hindsight's a wonderful thing, of course.
And I'm sure I've seen something the other day in terms of regulators. I think there's been like a 4 times amount of regulator bodies, brought into absolutely every single industry since back then.
Yeah, because fundamentally what happened was the industry, it all went wrong overnight, like I say. And basically, the regulator stepped in, you could argue, after the horse had bolted, but whatever. The regulator stepped in afterwards and looked at what had gone wrong, looked at the mess that was left, and basically turned around and said, well, you're not doing that again. So we're going to stand over you with our big teeth, and you're not going to lend irresponsibly. Yeah. You're not going to lend people, first-time buyers with bad credit, too much money. And if you do, we'll fine you £1 zillion. Yeah. So the lenders are all under the microscope and dare not step out of line now because they're in trouble.
Understandably. So, in terms of a first-time buyer applying for a mortgage, before they come to yourself, what steps should they be taking before ringing you?
Ring any time.
Yeah.
But if you're not ready, I can explain what you've got to do to get ready.
Yeah.
But ideally, they've saved the deposit up. They've not got any bad credit, and ring me and we'll go from there.
Of course. What are common mortgage myths that you see?
Common mortgage myths?
Yeah. Is there any that you see or not?
Myths.
Could have put you on the spot here.
No, I would say no. It's a good one. I would say that a common mistake is people often, if you've got a mortgage product, any mortgage product in the world, whether it's first-time buyer or not, doesn't matter, but we're talking about first-time buyers. But with a mortgage product, there's a number of different pieces to the jigsaw There's whether there's a fee with the deal or not, whether there's any cashback with the deal or not, whether it gives a free valuation, whether it's a fixed rate for 2 years, 3 years, 5 years, You've all these bits of a jigsaw. And then the final bit of the jigsaw is what's the interest rate. Now, what people make the mistake of is they look at the interest rate and nothing else. And it's whilst the interest rate matters, but what you can often find with mortgage products is sometimes the lower interest rate is not actually the best deal.
No. You've told me this before, I'm pretty sure.
Yeah, because you've got to look at the whole package.
Yeah.
Has it got cashback? Has it got a fee? Has it got a free valuation? And you've got to look at the whole thing to decide what's a good deal or what isn't. But what most people do is they just look at the interest rate on its own, which is not the full picture. So I'd say that's a bit of a schoolboy error.
Yeah, thinking that the lower mortgage rate's the best deal.
Yeah, and sometimes it is, but not always. The whole point is that the systems that we use and the sourcing systems will work all this out for us.
Yeah.
And it'll say, actually, that's the best deal for you based on how much you want to borrow.
Of course.
And it's not always the lowest interest rate.
No. Say you're with a first-time buyer and you're putting a mortgage application together. What can delay the mortgage application? Is there anything in particular? You know, they take out some sort of credit whilst you're doing the application or anything along them lines? What can delay it?
They need to be a bit organised and have all the documents ready. So pay slips, bank statements, copies of identification, proof of deposit. If they've got all that together and can handle that rather than not delay it, that would speed it up.
100%. I say this as well to people who come to me as well for my services. Just have everything ready before we get it open. If they've got a copy of the credit file, that's always a good one. Yeah. I think you can get them through Experian.
You can. There's a number of places you can get them from. But again, I would say, you got to remember that we're talking about first-time buyers here who, by definition, have not done this before.
No.
So they don't know often that we're there to help them and say, look, this is what you need to do next. And I can very quickly give them a little shopping list of get that, and then they're good to go.
Yeah, that's what I advise as well.
Yeah.
ID up to date, your bank statements up to date, proof of address up to date. You just need everything as organised as possible because by the time you're back and forth, it can just delay. It can delay by a week, 2 weeks, and that can sometimes just delay the whole transaction. Especially with myself, we're doing the.
No, you're right. But I think the other thing as well that it's easy to forget when, from sort of my perspective or your perspective, anybody who's in the sort of the advising role, whether it's the legalities of it or the mortgage or whatever, it's very easy to forget that first-time buyers by definition, have not done this before.
I think we become immune to it, don't we?
It's very, very easy to forget that. And it sounds obvious that.
Yeah.
But I do think it's a big point actually, I do think a lot of advisors, not intentionally, but make the mistake of assuming that the customer knows more about this than they do.
Yeah.
And the brutal truth is, by definition, if you're a first-time buyer, you don't actually know anything about this.
No.
Because you've never done it before. It's all right if you're doing it all day, every day for 36 years or whatever it is.
Yeah.
But if you've never done this before, you're not going to know the first thing about it. And there's no silly questions. And as well, I think a lot of advisors make the mistake of talking too jargony.
Yeah.
And I think they think that if they don't do that, it kind of sounds like they don't know what they're talking about.
Absolutely.
But in my opinion, you couldn't do anything worse because the poor first-time buyer goes out the meeting, and I've heard them say it to me loads of times. I didn't understand half of what I was being told.
100%.
Now that's no good.
Yeah.
People have got to have things explained and it's not patronising, but just in simple, plain English.
Just layman's terms.
Just layman's terms. That's what people need.
I think that's what can be the issue with us. You know, we can be dealing with someone who's bought the 15th, 16th property, and we're just speaking to them, they completely understand it, and then we go onto the phone to someone who's a first-time buyer, try and speak in the same way, and they're just blown away by everything. They don't know what's going on. Correct.
You're absolutely right. You've got to very quickly work out who you're talking to, because I mean, obviously, this is all about first-time buyers, but you're the same as me. We speak to many people who aren't first-time buyers, but you've got to pitch almost the way you deal with it based on what they are.
Yeah, absolutely.
And it's easy just to forget that people don't know anything about this.
100%. We've done the application we just spoke about. You've got to pick the legal representative. What advice would you give them? Would you tell them to go with the cheapest one? Would you tell them to go with the most expensive one, the local one? Check the reviews.
No.
What would you say to them? Because, you know, sometimes it is easier for a first-time buyer to go with the cheapest one due to their affordability. Sometimes it may not be the best. What would you recommend?
No, I would say the same thing every time, and have the conversation today twice, and I have it 5-6 times a week. Again, people aren't expected to know this because they've never done it before. And I sympathise with first-time buyers when they're trying to pick a conveyancer, because the only tangible piece of information they have to go off is a quote.
Yeah.
So if they've got one quote for 1,500 quid and another one for 1,400 quid, the temptation is to automatically think 1,400 quid is better than 1,500 quid because I'm going to finish up with 100 quid extra. So, big potential mistake. What matters the most about the conveyancer, in my opinion, I mean, you are the conveyancer, you know more about this than I do, but what matters from the mortgage advisor's perspective about the conveyancer is that there's a relationship between either the customer and the conveyancer or the advisor and the conveyancer, because what the quotes can't tell you is that when you reach the legal stage, if something starts going wrong or needs sorting out, or it's delaying or it's sticking and somebody needs to grab hold of it and sort it out, that's when the relationship, like if I'm dealing with one of your clients, I know that I can ring you on your mobile. You answer it in 10 seconds. And I can say to you, Pete, this is a problem, that's a problem, or the other problem. And it's sorted out in 10 minutes.
Yeah, exactly.
So the relationship between the mortgage advisor and the conveyancer, or it could be the client's got a brother who's a solicitor, brilliant.
Yeah.
But either somebody has to have that relationship with the conveyancer, that close relationship with the conveyancer, so that if something sticks, it can be sorted out like that. And when you're looking at the quotes, you can't tell.
No.
And that's, I think, the most important thing.
Yeah. So even when you are looking at the quotes, you do get that, you know, the £1,400 or the £1,500 one. Would you tell them to potentially look at the reviews on Google or Trustpilot?
Yeah.
Yeah. That's what I sometimes
do
as well.
Absolutely. I mean, there's a lot of that stuff available now, and that's great. But again, if you've actually got a personal recommendation where you know somebody who's used them, then that's the best way of all.
Absolutely. I'd 100% say that, because, you know, when it does come to the nitty gritty and there is an issue, you need something in the line.
Yeah.
This is what I speak, you know, when I'm working with the estate agents I work with, they just want someone at the other end of the phone when there's an issue who can answer the phone and deal with it, whether it's with the client, you know, the seller's solicitors. They just want someone to deal with
whoever,
it.
exactly.
Not sometimes, you know, you get put through to someone and they're not available and it goes missing. Do you know what I mean?
And of course, the classic example of that is, and you'll know more about this than I do, but you go online and you search for conveyancer, and you know, you get these quotes and you might find one that's much cheaper than the other. Well, on the price, you think, oh, that looks good. But when it comes to the nitty gritty and the work's actually being done, you try and get hold of somebody. You know, you
Yeah,
can't get hold of anybody. There's not even a phone sometimes. All you can do is email. And if you get an answer in a couple of weeks, well, good luck. Well, that's not, you know, the fact it was 300 quid cheaper, waste of money.
100%. It's sometimes what I say to my clients as well. I say, look, if there's an issue, here's my office address. Knock on.
Exactly right. Exactly,
and I think that's beneficial, just knowing that you've got someone, whether it be local or just someone you can trust, just 100%. That you can get hold of them.
Yeah.
So I think that's a big thing. Now, going on to the terms in a mortgage, you know, we're looking at 25, 35, 40 years. What would you recommend to a first-time buyer? Does it matter, or what would you say?
So always the generic advice is the shorter the mortgage term, the better. Because the mortgage will be paid off quicker, the balance will fall quicker, and the amount of interest that the customer is charged will be less.
Okay.
Having said that, one thing which a lot of people don't realise is that a lot of first-time buyers, especially when you buy your first house, you're going to want to get stuff for it. You're going to want to do things to it. So what some first-time buyers like to do is take a longer mortgage term, which gives you a lower monthly payment. You've then got more spare cash to do stuff to the house. Because in the early years, that's what you're going to want to do.
Yeah.
So that's an idea as well. And the other thing that people don't appreciate with that scenario is you can always take a longer mortgage term and then overpay.
Yeah.
And you've then got the shorter mortgage term, even though it doesn't say so on the tin. Those overpayments will bring forward the day when it's paid off, but they're voluntary.
So, I'm going to stop you there. Longer mortgage term.
Yeah.
Okay. Obviously, you're paying less per month.
You're contractually paying less each month. Yeah.
But then let's say you're paying an extra £200 every month.
Yeah.
But it's someone's birthday, and you need to keep that £200 to spend on the birthday.
That's
that 1 month.
You can turn the overpayments on and off like a light.
Interesting.
The point is that's the whole point of it. It's well put. The whole point of it is the customer has got the wriggle room. The customer's got more control over what they're spending each month. So I mean, you might say, well, what's the point in having a longer term and then voluntarily paying the extra money? Why didn't you just have the shorter mortgage term in the first place?
Gives you a bit of wiggle room.
You've got the wriggle room with how much a bit more control over what you're paying.
There you go. On to the next stage now. Okay. Let's just say, you know, I get a call. I'm looking at buying my first house.
Yeah.
I've spoke directly to the bank.
Right.
And they've offered me this rate.
Right.
I'm going to take a mortgage out with them.
Right.
That person there who's done that phone call and spoken to the bank and taken the mortgage out directly with them.
Yeah.
Would you recommend them doing that? Or would you recommend them speaking to a broker first? What would you recommend?
No. I mean, I would obviously say speak to a broker first. But there is besides my own selfish reason for saying that, is that there's a very good practical reason, is that if you ring the bank, you're only going to get the products that the bank are offering you. Whereas obviously with a broker like ourselves, it's literally our sourcing system looks at every deal in the UK, every lender on the planet, as it were. So we're legally defined as what's called whole of market, which means that, you know, we're not stuck with a few handful of lenders. It's whoever's doing the best deal. So it might be, if the customer comes to you, it might be that their bank is the best deal, but at least they've had the opportunity of seeing everything that's available.
So at the end of the day, you get to see more rates. You get an option of different lenders, which could be more suitable to a
all the lenders. Yeah, literally all the lenders. Our sourcing system is quite an incredible piece of kit. It literally is updated overnight, every night. So by 9 o'clock every morning, that list of deals is every single deal bang up to date with every detail.
Interesting. So from tomorrow, in 18 to 24 months' time, what do you see the mortgage rates being? Can you give a prediction maybe or not?
No, you see, this is also an interesting. This is a conversation I have a lot because, but I try and not give a prediction, not because I'm trying to dodge the question, but let's just look back at what's happened. We don't need to be old enough as I am to remember the financial crisis and all the rest of it. Let's just look back 5 years at what. So we've had a pandemic which stopped the world in its tracks.
Yeah.
We've had a war in Europe. We've had crazy political things going on. If somebody had said to you or me 5 years ago any of those things were going to happen, we wouldn't have believed any of them were going to happen, let alone all of them.
No, in one ear, out the other.
All of those events can affect what's going to happen to interest rates. So crystal balling, trying to crystal ball what interest rates are going to do is, I say I'm not trying to dodge the question, but it's I say if the last 5 years has taught us anything, it should have taught us that trying to guess what's coming next is a really bad idea.
Don't predict the future.
No. And this of course is the thing at the moment, is going back to these different deals, fixed rates. All day, every day I'm having the conversation, do I fix for 2 years or 5 years? Because what most people are trying to work out is what's going to happen to interest rates, because that'll determine which one's the best. You're not going to know what's going to happen to interest rates. You can't make the decision today on that basis.
Okay.
If somebody says, I'm going to be in that house for a decent length of time, then 5 year fixed rate.
Yeah.
You know, if somebody says to me, I'm going to buy this house, give it a bit of TLC, live in it for 18 months, see how it goes, sell it, move on, 2 year fixed rate sounds sensible. Nothing to do with what might or might not happen to interest rates, just purely on the customer's circumstances. That's what should drive it.
Interesting. Now, on to the next point. Is technology changing the mortgage industry at all or not?
Yes, it's changing aspects of it.
In which ways? Maybe
Well,
valuations or?
Yeah, a lot of automated valuations. It's speeding things up. Automatic verification of income. So it's a bit like a lot of things in life. I think is that a lot is different, but a lot isn't. There's a lot of things changed. to stress how old I am again, when I started doing this, driving all over the northwest of England, you never did anything with anybody you didn't sit down with face to face. So I used to do how many thousand miles a year, driving all over the northwest, meeting people, sitting face to face. And if you wanted to ring the office, you had to stop and find a phone box. Well, again, most people don't understand that, but that's the way it was, I promise you. And it wasn't in the prehistoric ages, but that's the way it was.
Sounds like it was.
Well, I'd say it might as well have been. But so basically, what I'm saying is, a lot has changed. I mean, we all the applications in those days were literally paper, fill them in ink, customer signs them, envelope, post.
How long would that take to do?
Well, however. Yeah. So where those things are very different now, what we now do is we sit at a desk with a screen and do the application like that. That's very different. But what has not changed is people's appetite for buying a house. And people need guidance and help, and that'll never change.
No. Very interesting, Simon. So to round things off now, what is one key piece of advice you'd give to a first-time buyer?
Speak to a broker. He or she will be able to tell you what you need to do, what you shouldn't do, what you need to do next, how to get your ducks in a row. I mean, I speak to a lot of people and the end of the conversation is, look, let's speak again in 6 months.
Yeah.
So it's just about whatever stage a person's at, just helping them and guiding them about what to do next. Because as I've said 100 times here, they don't know. They've never done this before. They just need some pointers and some help. So that's what I would say they need to do.
Amazing. And Simon, where can people find you? Can they ring you? Have you got a website? Where can people find you?
Yeah, absolutely. Yeah, we're I'm part of a firm in Southport, firm of mortgage and financial advisors called Burn Financial Limited. We are a member of a national network of advisors called True Potential. You can find us 15 Anchor Street, Southport, PR90UT. My email is Simon Garthwaite, all one word, SIMONGARTHWAITE at tptangopapallp.com.
Amazing. Well, thank you very much, Simon. And thank you very much, ladies and gentlemen, for joining episode 4 of the First Time Buyer Show with the man himself, Simon Garthwaite. Been in the industry for 36 years, absolute veteran, earned his stripes, so takes advice. Any questions, leave a comment below and I'll ask the professionals in the next episode and series. Thank you very much and I'll see you soon.